Shares turn negative and the euro tests two-year lows as more bad news piles up in the eurozone. This is today's Market Pulse. So the private sector in the single currency area shrinking for the sixth straight month as manufacturing output slumps, all pointing to a slide back into recession. With me is Chris Williamson, chief economist at Market, which of course compiles the Purchasing Managers Business Surveys. Chris, good to see you again. Does the contraction we've seen in Germany wipe out the gain we got from Japan earlier? From China.
From China. It certainly counterbalances it quite significantly, possibly wipes it out when you look at what's really going on behind those numbers. The Chinese numbers, yes, the output index ticked up, but employment's being cut at the fastest rate for 40 months. So Chinese companies are obviously starting to retrench. Is maybe not just the employment scene as well there, but their investment in capital equipment, because you look at German export orders, which are predominantly geared towards plant and machinery going out to Asia, for example. That's falling at the fastest rate for 3 years now. So it looks like, you know, China is still contracting. It's still in trouble.
Sticking with jobs, because you mentioned them in China, job losses in Germany. I didn't think we'd be saying that for a while, but we're seeing that now on the manufacturing side. Yeah,
the index dipped into contraction there. We did have a little small contraction of the employment index earlier this year. It's gone back down into negative territory. So that's adding to the obviously job losses that we're seeing in the rest of the region as well. So across the whole, a 2.5-year high rate of job losses in the eurozone.
So the story here, or one of the headlines, is clearly that this downturn has become entrenched in the core as well as the periphery in Europe. What does that mean for GDP?
It's certainly looking like the eurozone contracted in the second quarter. We estimate from these numbers around about 0.6% quarter-on-quarter decline. Now, the PMI for July was exactly in line with the average that we saw over that second quarter. So it looks like we're still sort of running at that rate of contraction. Which direction it moves next, we don't know. The decline could, of course, be worse than that 0.6%, because some of these leading indicators are still very negative, increasingly negative, suggesting that conditions could worsen further.
But convergence is the buzzword, isn't it?
Convergence, but unfortunately, in a rate of contraction. We'd seen before the periphery was contracting at the fastest rate for 3 years. France and came down to sort of join it at that steep rate of decline, and now Germany's coming down as well. So everything's converging in negative territory.
Price pressures have come off. You know, it's ironic. We'd like this gives policymakers more leeway, clearly, but there is no room, of course, to cut rates. What do you want to see from policymakers, from central banks?
Well, I don't know whether it's central banks so much. The issue is not really what central banks can do. That can obviously help. They can ease credit. They can make money more cheaply available and easily available for business and households. But part of the problem is that businesses and households don't want to borrow. They don't want to invest. They want to save as much as they can because the outlook is dark. And until leaders can bring households and businesses around to thinking that the outlook is brighter, then we're going to be stuck in this cycle of austerity and downgrades to deficit targets and so forth.
Yeah. All right. Chris, stay with us. A couple of other things I want to mention very quickly. On top of the gloomy PMI numbers, there are several other developments testing the resolve of investors in the eurozone today. Spain's short-term borrowing costs climbing in a debt auction to their second highest since the birth of the euro, all adding to speculation that Madrid will have to bow to a full-scale bailout. And Moody's threatens Germany's top-notch rating, the agency moving Berlin to outlook negative, along with the Netherlands and Luxembourg. Finally, the international lenders returning to Greece on a make-or-break visit to decide on a 130 billion euro lifeline. The euro, not surprisingly, under pressure, the single currency hovering around $1.21. The next downside target, the 25-month low at $1.2067, and European shares falling under the weight of all those concerns. Banking and insurance stocks leading the declines. Chris, just a quick word on this Moody's move. That was one of the big headlines this morning when we came in alongside the China PMIs. Moody's warning the market that we may see a further move on Germany's rating, it kind of fits in with this picture of the PMI, doesn't it?
It does. Yeah, Germany's economic environment is deteriorating. I mean, there's nothing new with what we're seeing from Moody's here, but what they're saying is that the risks of an increased exposure to Germany to a potential bailout for Spain has increased, and also the likelihood of a Greek exit from the euro has increased. Now, both of those are going to have implications for Germany. The first via the funding of a bailout, and the second via the problems in the financial system that will erupt from a potential Grexit.
Yep.
So that's what they're warning about. They're saying they're perceiving that these risks have increased, and therefore that Germany faces a bigger exposure. There's nothing new there, but it is a reminder, especially with the Troika going into Athens at the moment, to see quite how they're doing in their deficit reduction.
Okay, Chris, many thanks for that. Chris Williamson from Market. That's it for now. Join us this time each weekday for Market Pulse, a snapshot of what's moving on financial markets and why. I'm Axel Threlfall. This is Reuters.